Hello and welcome to the Golden Gate Computer Society monthly general meeting. I am Marcelino Nogueiro, president of the Golden Gate Computer Society. This meeting is being recorded and will be posted in our YouTube channel. If you're watching the recording in the future, please be sure to like and subscribe to our channel. Those watching live, please keep your microphones muted during the presentation. We will have a Q&A after the presentation. And okay, I'm turning it over to Ron to go ahead and introduce our guest speaker. Thank you, Ron.
Yes, it's my pleasure to introduce Marc Samborski from Perotti and Carrade. And we have a relationship that goes back quite a ways. And Perotti and Carrade, especially Marc, has been a very generous um, donor to the school support project that we've hosted for as many years as I've been a member of the club. Also, Marc is an IT manager for Perotti and Carrade, in addition to his tax expertise. And it gets very intense around Perotti and Carrade around this time because they're getting ready for the tax season. And it brings to mind uh, um, an incident that Shirley had when she was working for them, and especially with Marc. She sat up about 2 o'clock in the morning in bed and said, "This has to get out right away." And it was in the middle of tax season, and she said it again, "This has to get out right away." And she's sitting up there with her hands out. And she said it a third time, and I said, "I'd take care of it." She went, fell right asleep, just like that. She just needed somebody to take care of it. Anyway, that's about it for me. You can read the resume online, and I'll let Marc speak for himself. Marc?
Welcome, Marc.
Yes, look forward to visiting with everybody this evening and hopefully give you a little something. I'm trying not to make your heads explode with too much information because the tax changes can be weirdly complicated. But just to give you a little background, I work for Perotti and Carrade CPAs here in San Rafael, over by the Civic Center. I kind of started way back when in '89 and, worked my way up the ranks. So anyway, at this point, I'm actually probably technically the big boss of the place. And as my partner Dennis is kind of winding down, and we have about, five partners total. And we have a tax department and audit and where we can do financial statements for companies, and we do a whole lot of estate and trust work. So, that's a little bit about the tax side. Now the computer side that Ron mentioned, way back in my second job in the '80s, around '87, I worked in a city, and there was a computer guy that was sharing office space with us, and he kind of taught me some DOS stuff and about how to make computers faster, like doing RAM drives and things like that, and using high quality, trying to get the right amount of memory, and just to make your 286 computer to go faster, and then ultimately your 386 and 486 and so on. So by the time I started at Perotti and Carrade, I actually started custom building all the computers there, back in the early '90s. I would get all the best parts, put all the pieces together, video card, memory chips, and get it all together, create a RAM drive. And the reason why I did that is because when you had to calculate a tax return back then, it would sometimes take about a minute 45 to 2 minutes to do one calc. So imagine that. You make a change on the tax return, and you gotta wait 2 minutes for the tax return to come up on the screen. And imagine doing that 10 times. So when I did like the RAM drive, before I knew it, I go from a couple of minutes to a minute 30 to a minute to 30 seconds to 15 seconds. until we got down to about 3 seconds, over time. Um, and, my partner, Dennis, he always said, like, you're chasing nanoseconds at this point. But every nanosecond, when you're calculating, 1,000 or 1,500 returns, and you got to waste 20 seconds extra or 10 seconds is like an eternity. I mean, you all understand that. And so at this point in time, I kind of take care of probably about 30 computers, and everybody's got about two computers, a home computer and a desktop at the office. So I got to take care of about 60, 70 computers. And, I take care of all the setup and deployment. And then we have an outside computer guy from Marin Computer, and he helps me with the Microsoft and the doing the server part of the equation, the Office 365, and we have a security company now that has taken over my duties as security boss, managing this many employees. So we have a security company also watching over us. So anyway, I thought you might be a little interested in that. So I have a real love of computers, used to overclock the heck out of them, compete with them, and had a lot of fun with them. So nowadays I can buy Dell and Alienwares and, at a hefty discount and kind of get them all set up for the various departments and stuff. So that's what I call the fun part of work. Now, getting back to the tax side, Rod wanted me to talk about the OBBA. That's the One Big Beautiful Bill Act, right? And as we know, it came around in the summertime and kind of kind of rammed its way through Congress and was approved. Now, when you think about this act, there's a lot of stuff that really is not much different than what we were used to back, when they passed under the first administration back in December of 2017. They sort of codified a lot of the stuff that we've been used to for the last, call it about 8 years. And but there are some significant changes that, probably a lot of you are aware of, but we want to kind of touch base. And I was trying to focus a little bit on, from a senior point of view, plus 65 point of view. And I kind of notice in the screen that seems to be pretty much everybody. And we're all 29 in our heads, but a little older when we look in the mirror, right? And so the first one is, are most of you should be familiar by now because we live in California, that they changed something called the SALT limitation. And what that meant is, it's the state income tax limitation that we have in our tax returns. So back in 2018, we could have had $100,000 of state income tax and real estate tax and DMV fees, but we only got to deduct $10,000. Okay. And so that affected, people in high income or high bracket states like California, New York, different things more than, let's say, being in, low tax bracket states like New Mexico. So at that point, we went to, $10,000 limit. But now under the new OBBA, we now have a $40,000 limit. So that means if you have a home, let's say a more expensive home and you're paying 25,000 in property taxes and let's say you have about 15,000 in state income tax. Well, now you get to deduct that, but there is a caveat for that. And that has to be that your adjusted gross income basically stays under $500,000. Okay. And once you get past $500,000, it starts to phase out. And most of you probably have heard this term phase out. It applies to a lot of different tax laws. And once you get to $600,000, you're back to 10,000 bucks. So if you're fortunate enough to, have income under 500,000 and you have a lot of state income taxes, you have a $30,000 increase in your state income tax deduction. So not if that makes sense to you so far. Okay. And so in this case, sometimes you have to then pay attention to your property taxes because in a year that you have, let's say, a house sale or a big capital gain, and you can't use all of your state income tax deduction, let's say you're limited to 10,000 bucks, but the following year you don't have a big capital gain, you don't have a house sale, anything like that, your income's lower, like under 500,000 or under 600,000, then maybe you want to, decide when you want to pay your fourth quarter estimate for California. You might want to shove it into another year where you actually get to use it. So you have to talk to your tax accountant when, like all of a sudden you have with the stock market the way it is, you might have a big capital gain one year and a capital loss or very little capital gain another year. So pay attention to that. Now, another change that they've made is charitable donations. Fundamentally, we still have a 60% limit on cash donations for the feds and 50% limitation of, that's an AGI or adjusted gross income limitation, and for California. And certain things like appreciated stock, when you're giving away, you got your IBM, your Apple for a long time, and you got a big gain, and you want to give it to a charity, you're limited to 30% of AGI. So most people, tend to know those kind of rules. But one of the changes they've made charitable donation changes to non-itemizers. Okay. So, because our itemized deductions have gone up so much in the last few years, and especially if you're a senior, you get an extra amount of donation, an extra itemized deduction. Oftentimes, your charitable deductions are sort of useless. You don't get any benefit for it because you're using the standard deduction. So they have allowed basically a deduction for non-itemizers. It's about $1,000 for single and 2,000 for married people. And again, it phases out when your income gets, over a certain bracket. So you want to pay attention to, do you get a benefit? And so the way around it, one of the ways around it is, let's just say you're close to the itemizing limit. Let's say your itemizing limit is 33,000 or 40,000, depending on, if both husband and wife are, over 65. And you're close to the limit, you may want to not do much charity in one year. Okay. Let's just say you usually do 5,000 or 10,000 a year. You may not want to do it one year because your standard deduction will take care of it. But now, if you go to the next year, you kind of double that. So if now you were normally at about 38,000 and your itemized deduction limit was, your standard deduction was 40,000, you now do a 10,000 in year two to take advantage of going over the standard deduction. Okay. And that's where you sometimes they tell us in our classes, when you're got a standard deduction, you may want to do that with your itemized deductions. Now, you always want to remember California doesn't follow the federal rules for a lot of stuff. So your standard deduction for California is generally much smaller. So you actually get to use, like we talked about, real estate taxes in earlier, or charitable donations. And if you had $25,000 of real estate taxes, or you had a decent amount of charitable donations, you probably will get to use it for California. So you always want to itemize your California, even if you can't itemize your federal. We see that a lot when we're preparing returns. Um, Things didn't change really that much with mortgage interest, pretty much the same. All your mortgage interest is still grandfathered in at $1 million or for Fed or 1,000,001 for California when it was before December of 17. Any new stuff you buy still at 750,000. So that shouldn't be anything new. But don't forget California has a bigger limit in mortgage than the feds. So even though the feds might be 750, California is generally 1,000,001. It's 100,000 plus, I mean, it's 1 million plus 100,000 for the HELOC type interest, you know. You probably may have heard, if there's any gamblers among you, that we have casinos not too far from here. They've limited the gambling losses a little bit, not too much, but it used to be like if you had 100,000 of gambling winnings and you had 110,000 of gambling losses, you now your gambling losses that are limited to zero. So your losses offset your gains. But let's just say you had 100 income and 100 losses. The losses are limited to 90% of the losses. Okay. So you would have maybe $10,000 of net gambling income. On the other hand, if your losses are 120,000 and you take 90% of it, you get to use everything up to the 100,000 of earnings. So that only applies really to the gambling, side of the equation. Not too big of a deal. Um, you probably heard also that there's a senior deduction, itemized deduction, like you have your normal senior increase in your standard deduction, for husband and or wife. But there's also sort of a bonus senior deduction of like 6,000 and 12,000 that stacks on top of your regular itemized or your regular standard deduction. And again, it's a little bit income limited. So it doesn't really help a if your income is really, on the high side, it doesn't help you much, but it definitely helps those that tend to be on the lower end of the spectrum. You get an extra 6,000 or 12,000 standard deduction. Um, so that kind of stacks on top of your regular standard deduction plus senior that you already have. And And I think the phase out is 75,000 for um, single and 150,000 for joint. So once you get past 150,000 for, your modified adjusted gross income, then you kind of lose the benefit of that extra senior deduction. And you have to remember, California doesn't adopt any of those changes, okay? So even though you might have a bigger standard deduction for Fed, you kind of lose out. There is no extra senior on the California side. So just kind of remember that. And also when we talked about the SALT limitation, the state income tax deduction, the only thing that's going to be deductible in California is going to be the DMV fee and the real estate taxes, no state income taxes. Okay. Are there any business owners here that have any kind of Schedule C self-employed businesses or S corporations or partnerships, that kind of thing? Anybody? Otherwise, I won't spend that much time on it. I might just mention a couple of things. They did increase our bonus depreciation back to 100%. So if you have a small business and now you bought like some computer equipment, office equipment, maybe even things for your rental property. Oftentimes we have a rental property, we have residential and commercial. We now get bonus depreciation, for short-lived assets, like appliances in a rental or carpeting, things like that. And there's also something called Section 179 depreciation. It tends to apply more to actual businesses. And again, California has never adopted bonus depreciation. So always get that thought out of your head. And they have a very limited Section 179 deduction, even though from a federal point of view, you could have a $2.5 million, you can write $2.5 million if you have a big enough company in bonus depreciation. Yeah. And do we have anybody that owns real estate? Okay. So when you have real estate, whether it's, residential or commercial, we have something called, and also a business, we have something called the qualified business income deduction. And that's basically a 20% deduction. It's a federal only thing that applies to your net profit, and it's a deduction, an extra deduction on your federal return. And there are limitations on it, how much you get to use, depending on are you paying out salary for your business to anybody? How much is your building that you bought? Like if you have a commercial or residential property and you paid 2 million bucks for it, that figures into the limitation of how much of this 20%. But a lot of people actually do qualify for a big, nice deduction on the Fed. So always keep that in mind, the qualified business income deduction. So that's kind of it on a little bit on the small business side. Now, just kind of let's get back to our itemized deductions. We covered some of the basic ones, but let's cover stuff that's kind of new, like really new. Okay. And you probably heard there's probably about three things or so that are really new. One is called the $10,000 car loan interest deduction. Okay, as you probably known for many years, unless it goes into a business, your loan interest has not been deductible since probably about 1986, if I remember correctly. And so they've got this deduction if you buy a new car, it has to be made in the United States. You get to deduct the car loan interest up to 10,000 bucks. Now, again, there is an adjusted gross income limitation, and the limitation tends to be um, it's between 100,000 to $200,000. So, it doesn't apply to leased cars, anything like that. But basically, you have to buy, a new car and be under the income limitation. So, depending on that, keep that one in mind. We also have the overtime and tip, no tax on overtime and tip. And probably most everybody's either got their own little business and or they're in semi-retired or retired mode. Doesn't apply too much, but you may have your kids and grandkids that are working, especially if they're in the restaurant business or the beauty business or anything that has tips or overtime. They're working for, like our front office gets overtime, during tax season. And so when you get over 40 hours a week, um, the part of that is excluded up to a certain amount. And again, there's a limitation on it. Or if you got tips that's reported on your W-2, there's very specific reporting. You might, part of that's going to be tax-free also. And again, that's a federal only thing. But you may have, friends or family members that might bring it up that are, kind of do that kind of thing. I just thought I'd toss that out there because it's not going to really affect you too much. And California, they don't have any of these things. They do have a sort of a new senior caregiver credit, which is a new refundable credit, helping families where you're taking care of an elderly relative who lives with them. So if you have somebody that lives with you, um, then you might want to think about that. That's a California credit, and that's kind of a newer thing. Um, they've made changes to The other thing is if you one other thing on the business side, if you have a corporation, an S corp or a partnership, you generally and you're collecting a salary from it and you're still working and still operating the business. You want to make sure you're doing the California pass-through entity tax deduction and credit. That's a real big deal. That's gotten everybody around the $10,000 tax limitation that we've had. It's in California. It came into being in 2021, and we use that to deduct the state income tax when you're over the $10,000 limit, or let's just call it the $40,000 limit. And so, for example, I had a client where they were paying about 680,000. It's running a company, 680,000 of state income tax deduction that was being deducted on their individual return. And by the company paying for it and giving the credit to the individual, they were saving 37% of 680,000 on their taxes. I call that free money. So before that, you didn't get to deduct it, period. So after that, we got to deduct the whole thing. Now, this only applies to S corporations, multi-member LLCs, and multi-member, partnerships. So again, you may have, family members and sons, daughters, different ones that have businesses, and I've had some new businesses that have come to me and they didn't do it, and I said one just recently, about 3 weeks ago, and I said, "Wow, you threw away a $36,000 tax savings." I tried to explain to them, you got 90 some odd thousand that you're paying a year in state income tax, and the company should have been paying that. And then California gives you a credit, so you're paying the tax on the company side, you're not paying it on the individual side. So that gets rid of another nice benefit is that you don't have to pay your California quarterly estimates, your personal California quarterly estimates on your individual return. It's done through the company, okay? And so you really only have to focus on your federal estimates, unless, of course, you have a lot of interest, dividends, cap gains, and stuff like that. So keep that in mind. The other small change, California's kind of thrown in a hidden tax, kind of 1%, for if you have wages. We've all heard of SDI. We worked our whole lives, had SDI, state disability insurance, and it used to be a small amount of our paycheck, right? And it's been sneaking its way up, and it still had a limit, so maybe we paid $1,000 in SDI. But now it's 1% of your salary without a limit. So if you have $1 million, your $1,000 became $10,000. Okay. So that applies to, of course, you're a doctor, you got a corp, you're making, call it a million, you got a good practice where you're making over $1 million and you got maybe a $400,000 salary in the S corp. So now all of a sudden you went from $1,000 SDI to 4,000 on your 400,000 salary. Okay. And that leads me to another thing is if you do have a business that's making a decent amount of money, we oftentimes don't recommend a Schedule C. If you're making over, call it a couple 100,000 a year net profit, we usually recommend being some kind of a LLC or an S corp. And there's lots of pluses to that as far as not paying so much Medicare tax, that 3.8% Medicare tax that we all dread, and also getting to use this California pass-through entity credit. So sometimes the benefit of using an entity versus running a sole Schedule C. If your Schedule C is kind of small or under 100 grand, no big deal. But if now you have, call it a pension, let's call it a 401k, a solo 401k, you're making 100,000 on your little business. Also consider like a solo 401k. And even though we're over the limit, we can salt away quite a bit of dough. into the 401k, or it could even be a SEP IRA. Even though we're beyond maybe, the normal 70 and a half, we can still put away money into these retirement accounts. And so if your income is already kind of high, you don't have to pay unnecessary tax, and you can take some of your your self-employment earnings or that, and or even with a little corporation, and kind of reduce your income, which affects like your maybe your Medicare premiums, different things like that, that they take out of your Social Security. Okay, so let's see, anything else here? Okay, so you're all mostly familiar with home energy. Our solar credit, stopped in the end of December. So no more 30%, so a lot of us probably have solar already. And, it was a real nice credit. And, our EV credits, kind of stopped in September. But I'm a car guy. My other hobby is cars. And there still are, and I have a number of electric vehicles, and there still are insane lease deals on, let's call it, electric cars. Some of them are mind-boggling. They're basically like zero interest, and they give you credits that are not from the federal government, but from the manufacturer. So, pay attention to that, because I'm seeing friends buying stuff, as we talk about, you'll see like maybe a Honda Prologue or the Toyota Electric or some of these different ones. And even some of them, they just have amazing deals if they're a year old, whether you buy it or lease it. And so, don't just toss out the fact that the federal government stopped the $7,500 credit. Just my side pitch for electric cars. Um, and then, okay, so let's see. Most of all these other things that we have, we don't really need unless you have kind of a bigger business. And so I won't bore you with that. And anyway, I think that's kind of really what I wanted to talk about. And, I'll kind of toss it out there, if anybody has some questions.
Well, Mark, thank you very much. That was very informative, eye-opening stuff too. So what we'll do now is I'm going to go ahead and stop the recording, and then
Okay.
we'll just open it up to Q&A. Thank you again, and I'm going to stop recording now.